Just a little bit of housekeeping before we get into the exciting story of the 2019 valuation. First, want to let you know that we are we'll be sending out a recording as well as a copy of the slide deck after the webinar. So you don't need to do screenshots or write everything down. You can actually just listen, pay attention. If you have questions during the webinar, use the chat box, send them to us. We will be monitoring it as we go along. We may not answer the questions right away. If we plan on talking about the subject a little bit later, we'll hold off on the questions until the right time and then hopefully get to all of your questions. We'll also have a chance at the end to ask more questions. And if you just have questions later in the night, tomorrow night, while you're trying to sleep, suddenly this urgent question about actuarial valuations come up, you can send us an email and we'll try and get back to you with all of your answers at that point. And also just a heads up, our next webinar, since you're having so much fun already, our next webinar is going to be next month, September 16th, and we'll be sending more information out about that shortly. Again, thank you all for joining us today. We're trying a new Zoom format for this, so you all had to fill out forms and do other things, and the fact that you worked your way through that, we truly appreciate it. So today we're going to start out by going through the results, just the main things you're going to be focusing on when you look at the report, the funded status and the contribution requirements, talk about where you are now, and why those results changed from the prior year valuation. Then we'll spend some time going into the details of the report itself and the changes that they made in the 2019 report from the 2018 valuation reports. And then we'll also spend a little time talking about what you might expect to see in the 2020 reports a year from now.
All right, I'm going to present the results section of this presentation. So the June 30, 2019 actuarial valuations were just released by CalPERS. And you might be wondering, what does this mean for you? You can expect stability in your employer contribution rates and in your unfunded actuarial liability if several conditions are met. You can expect stability if your employee population was stable, and that means no significant terminations or retirements, and employees who left were generally replaced. Finally, that you didn't increase your active employee count in a significant way. So if these three conditions were met, then your employer contribution and your unfunded actuarial liability probably remain pretty stable. Also, on the asset side, you can expect stability if you didn't make any additional discretionary employer contributions. If you did make those contributions, that would change your unfunded accrued liability and therefore change your unfunded accrued liability payment. Finally, you can expect stability if you did not do any fresh starts of your amortization basis or combined amortization basis prior to the valuation date of June 30, 2019. So if all these conditions were met, your employer contribution rate should look fairly similar to last year's, and your UAL funded percentage might actually have improved slightly over last year's. If any of these things did happen, then you will see different results.
Right. And these are all things that you should be aware of on your side. These are not secret things that CalPERS and their actuaries or their board is doing. These are things that you have done. So you should have a good, a good expectation from your own activities, whether or not things are going to stay stable.
Right. Thank you, Ira. All right. So now if you happen to have a copy of your report nearby on a second screen, or on your first screen, you could open it up if you'd like, follow along. the funded status summary is on page 6, and it's similar to how it was displayed last year. You have a side-by-side comparison of the previous valuation, which was June 30th, 2018, and you have the new valuation results, June 30, 2019. For this particular agency, you can see that their funded percentage did in fact improve slightly from 65.8% to 66.1%. On page 4, we have the contribution rate comparison. Like the previous slide, we have a side-by-side comparison of the prior year's valuation results and this year's. But with the contribution rate, there's a 2-year lag between the date of the valuation and then the fiscal years to which that contribution rate applies. So yes, thank you for the red dot there. So this year's valuation, or I shouldn't say this year's, 6/30/19 valuation produced contribution rates for the fiscal year 2021 to 2022. So that's the column on the right. Again, for this employer, you can see that the total normal costs went slightly down, and we're going to see a reconciliation of these rates.
Sorry, hold on.
Yeah, that's okay. Back it up. There we go. Thank you. The total normal cost rate went slightly down, probably due to the shift to more PEPRA employees. And so both the employer-employee contribution went slightly down as a percent of pay. Then a total dollar amount is estimated below based on those contribution rates. And the unfunded liability contribution is always calculated as a dollar amount, but then they give a illustrative percent of projected payroll. Then we get our total down below, 39.18.
And again, we talked about expecting stability. What we're seeing here is a lot of stability, a change from 9.77 to 9.73 on normal cost is about as stable as you're going to get. The unfunded liability contributions, we'll talk about why they changed at all. Again, relatively stable from 13 million up to 14 million. We expect a little bit of growth. So this is the kind of stability that we're talking about for the fiscal year payment that you're making in 2021-22.
Thank you, Ira. So when you open up your report, your PDF, on the first page is this quick summary. So for agent employers, this is what it looks like. It'll give you the valuation results, the fiscal year 2021 to 2022 employer normal cost rate, then the dollar amount of the amortization of the unfunded accrued liability, and finally the PEPRA rate. The classic employees, the rates are set. They're set, so it doesn't need to be, it's not calculated like it is for the PEPRA rate. Then they've given you a projection for the following fiscal year. And Ira's going to get into this. You can see the employer normal cost rate is projected to go down slightly. And that's one of the changes this year. And we'll talk about that later. The UAL payment has gone up probably because of ramping. And they can't tell you the employee PEPRA rate yet.
Right, it'll be locked in at some point in the future. Expectations, you should start with the expectation that it's going to stay stable at about the same place it was before, unless, again, you have major changes like we talked about before in your population, or there are changes in actuarial assumptions, and we'll talk about what to expect on that later.
So the next couple slides are what a risk pool employer might see. This is classic. Now they've given the employer contribution rate and the dollar amount of the unfunded and a projection for the next fiscal year. And let's look at the risk pool PEPRA. So again, it's given a PEPRA employee rate. I'm sorry, I'm skipping to the end. Employer normal cost rate, employer amortization unfunded, and then the PEPRA employee rate. And as Ira pointed out, it's to be determined in the following year, and probably expect stability there. All right, what happened in fiscal year 2018-2019? Well, the answer is not a lot. CalPERS did not change assumptions. They didn't change the financial, the demographic assumptions or the economic assumptions. The actuarial methods were not changed. The investments earned 6.7%, which is just shy of the 7% that was assumed. So again, that's why so much stability this year. No changes in assumptions or methods, and the investments earned close to the assumed rate. And remember that we're looking at 6/30/19 valuation. The 4.7 that's been talked about recently is the 6/30/2020 fiscal year end investment return. So we're looking back a year here.
Right, and all of the changes and everything else that you've been going through in this last year, we'll be talking about at the end and what to think about for the 2020 valuation when it comes out. But because of the lag between the end of the year and the 13 months later that the actuarial reports come out, we're looking at the June 30, 2019 report right now.
Great. Thanks, Ira. All right, so agent plans can turn to page 15. And here's that, I think this is a reconciliation between, we start with the 6/30/18 UAL of 284 million. And then item I shows where we got to on 6/30/19. And then there's a delta or a change between those two, the last line there. So how does UAL change? There's amortization payments made to lower it, but interest is earned on the UAL. That's the 19 million. There's so then we come up with our expected UAL. Then items E, F, and G show what I just mentioned on the previous screen, that there were no plan changes, no assumption changes, no method changes. So our expected UAL is the same, item D to item H. But then we remeasure and say, well, what was it actually? And so this then takes into account the slight, that 0.3% less asset return than expected, and the demographic gains and losses. In other words, maybe more people retired, maybe salaries went up more, etc. That's all captured here. So then we get our total gain loss for that fiscal year 18-19. So, as has been mentioned several times, the asset loss was very small for 2018-2019. And to be clear, you might think 6.7%, that's not an asset loss because it was over zero, but CalPERS assumed 7%. So we missed the mark, they missed the mark by 0.3%. So that's considered an asset loss, although very small. So this graph, a nice graph, it shows the actual returns for the last 20 years, the blue bars. Then the dotted line that kind of weaves all over the place is the rolling 5-year average of those returns. And then the sort of straight line is the assumed discount rate. And you can see there's breaks because if you look back 20 years, the discount rate was 8%, and now we're down to 7%. So that's why that line isn't quite straight. So this is shows that CalPERS actuaries, the demographic assumptions, the economic assumptions are meant to be long-term assumptions. Even there'll always be fluctuation every year on both demographic and economic assumptions. And if you look more to the 5-year average or even the 10-year average, you might see more stability in the economic return. Ira, do you have anything to add to this?
Yeah, and just this is also with the discount rate. If you for those of you who haven't been working in pensions for the last 20 years, you can see how CalPERS has gradually been making those assumptions a little more conservative over time for a variety of reasons. And we can talk a little later about the expectations of what may be happening to those moving forward. But again, a lot of stability in these rates during the early 2000s, and then in the last few years, they did the ratcheting down that you all got a chance to sort of see and live through. And that is part of the reason why your unfunded liabilities had been increasing from year to year. But in the 2018 valuation, they hit the 7% target, and they kept it there for this last year. So that's, again, the stability we're talking about.
Great, thanks. All right. An interesting slide here is the CalPERS asset allocation. In the chart on the left, you can see they've set policy target allocations. For example, the first line, public equity, they've set a policy target allocation of 50%, and what they actually have is 50.2. So CalPERS has set these allocations, and then the investment managers go out and fulfill those allocations. There's always a little bit of give. And you can see they're not 100% invested in equities. No pension funds that I am aware of are. And that the idea is investments are diversified to help mitigate risk factors. So you can see they have equity, fixed income, real assets, and some other investments in some other small categories there. So this makes up how they get to their 7% assumed discount rate, this asset allocation. Yes,
right. And in fact, during this year, the 2019-2020 year, we got to see in real time the value of their diversification as the equity portion plummeted during February and March, the fixed income portion. And you'll notice here that they actually combined some of them into major categories. So while we have different types of equity, private equity, different types of public equity, all of these fall into the category of growth. Different types of fixed income, short-term, long-term, more secure government type things, and high yield, all under income. The income portion, when the interest rates were dropped to help push the economy along, this section of the fund did very well in February and March. This section of the fund did not do well. This section of the fund did okay. Then when the Fed started pumping liquidity into the markets, this part of the fund started taking off beginning at the end of March. So this is where you got a chance during the 1920 year to see the value of this diversification in action. And CalPERS did relatively well overall compared to other public pension funds with a June year. So this is why they have diversification. During some years, sort of slow, boring, consistent years, God, I remember those days, we sometimes question, oh, why aren't they in the stock market? The stock market's doing so well. During the 1920 year, we got a chance to go, oh, this is why they're not 100% the stock market. Okay.
And Ira, we have a quick question from the audience that's probably relevant here. What are some examples of private equity investments?
Private equity investments are investing in, they get a chance to invest in some companies. Very often, some of them are, a lot of them are tech companies, but companies that are not publicly traded yet. So there are a number of big name companies that have not yet gone out for IPO, and when they go for I don't know if it's always Series A, it's usually like Series B or Series C funding, a big institutional investor like CalPERS, because of their relationships, will get a chance to invest in those. So that's one type of private equity type investment that they do on a regular basis. This also, I think that's also the category where they stick some of their more complicated exotic hedge fund type investments that are specifically designed to be a little more stable than the markets with better returns than fixed income. So that's sort of the short answer to the kind of things that fall into that category. Private equity is one of those categories that they expect to get better returns than the public equity type side, because especially if you're getting in early on some of these companies that haven't yet gone IPO, the upside, if you do it right, is very profitable.
Great, thanks, Ira. All right, this chart shows the new amortization policies that took effect with this new valuation, the 6/30/19 valuation. The prior policies had longer amortization periods had ramp up, ramp down. The new policy is much simpler. Most of the amortizations will no longer have a ramp. However, the investment gain or loss will. And so what happens, and this is actually says 6/30/2020, but we can apply it to 6/30/19, of course. So the returns are locked in, 6/30/19 in our case, what we're talking about. And then the actuarial reports are produced like the ones you now have. And there's a 2-year lag between 6/30/19 fiscal year end and when the new contribution rates are in effect. So you can see that this chart is meant to represent that 2-year lag. So for the reports we're looking at, we're talking about the contribution 2021 to 2022, the new rates will go into effect. There'll be a 5-year ramp where the contribution rate, just what it says here, ramps up. And then we have 15 years of stable contributions. And those are level dollar, not percent of pay. So that's the new amortization policy effective with this valuation report that we're reviewing.
And it's just for new actuarial bases that get created with this report and later reports.
Exactly.
I'll show you in just a second. Earlier amortization bases, you got set on an amortization schedule. All of those are growing as a percentage of payroll rather than level dollar. And all of the new ones are level dollar, with just the investment ones having a ramp. The non-investment ones have no ramp. They're just 20-year straight across the board. And we can see that if you look at your amortization schedules.
Right. So at the bottom here, we've highlighted the two 6/30/19 bases that are set up. So we have a non-investment gain loss. Again, that's demographic type gains and losses, no ramp, and it's 20 years. The investment gain loss, since it was just set up, we're at 20% ramp. The ramp shape is up only. It's 0% escalation, meaning level dollar, and a 20-year amortization. And if we just look at the gain loss right above those two highlighted ones, you can see that obviously was a 30-year amortization there. There's an up-down shape, etc. There's an escalation rate. So they've completely changed the amortization policy, made it simpler.
And also eliminated, to a large extent, some of the negative amortization that was coming in and was a concern for some. So this is another example of CalPERS being sort of constantly listening and adjusting their methodology over time as they hear certain concerns and find out that some of the approaches that they implemented to deal with certain issues don't deal with all issues, so they adjust as time goes on. Sometimes it's difficult to know that CalPERS is listening. This is an example that it may take them time to implement, but they hear your concerns, and you should keep letting them know if there's something going on.
Yes. Okay. So now normal cost changes for agent employers are on page 19. And this is again a reconciliation. Earlier we saw that the employer contribution and the employee contribution rate changed slightly. So we start with the previous valuation results, 9.77% total employer normal costs, and employee contribution 7.577, and then we have the total, the addition of those two. Well, how did that change? And as we mentioned earlier, for this agency we're looking at anyway, there's actually all agency, there's no plan changes, no assumption changes, no method changes. So that leaves us with demographic experience changes. And you can see it dropped a little bit. And the demographic experience, like I said, could be this extra retirements or salary related, but also the shift to new hires being PEPRA. So then that 0.067% drop in total rate is actually spread over or allocated between the employer and the employee. You can see that the employer's rate went down 0.04 and the employees went down 0.027. And that gets us to our new rates. All right, page 19 for agent employers amortization payment changes, again in reconciliation. We start with our UAL. You can see very small effective investment gain loss during the year, only 55,000. Very small because we almost made that 7%. Then we have a demographic, $500,000 there or so set up for the demographic change. And those are added up on line F. I'm sorry, no, that's not the, take that back. The 2.3 million is the effect of the ramping and the escalation rates. So that's what that is. That's why the UAL payment's going up, because there's ramps and there's escalation rate of level percent of pay. So then we add them up on line J to get to our new dollar amount, number 3 there, our new dollar amount UAL payment.
And again, we're saying this over and over again, but there are a lot of zeros here because of the stability with no changes in the schedules, no plan changes, no assumption changes, no fresh starts. So, you know, this is no method changes. A lot of zeros showing up. For most of you, you're going to expect to see a lot of zeros. Now, for those of you who actually made an additional contribution, we show an example of an agency that did that.
Yeah, so this is the same exhibit, but if we go to the H line, effective elimination of amortization base. So this employer has made an additional contribution that eliminated a base. So while their overall UAL contribution went up, again, due to ramps and escalation, they didn't go up as much as they could have because an additional amount was paid to CalPERS and the base was eliminated. So you might see this if you made that ADP prior to 6/30/19.
And right, and if you're wondering if CalPERS is registering it, this is where you can find that information on this page.
Yes. All right, well, I get to hand it over to Ira now. He's going to guide you through this section.
Okay, so now we get to talk about the fun and exciting report changes for those of you who read through the report completely and wanted to know, wow, these pages are different. Why? So let's start early. There is a new section early in the report where on page 5, between the pages where they give the summary of the employee contribution rates and the page where they have the summary of the funded status, they have stuck information about additional discretionary employer contributions. This so this is something they added. This is something that they've been they know that a lot of employers had been in the past. Again, keep in mind these reports, they decide what's going to be happening in the content of these reports starting June 30 the prior year, June 30, 2019, finalizing it in January of 2020. So at that point, the thought that a lot of agencies were putting in additional discretionary contributions. So they gave some information and gave you an ability to take a look at this. Since all of you are GovInvest clients, you have the ability to look at the software and get this by yourself, but a lot of agencies aren't doing that, and this gives them a heads up as to a quick way to understand what's happening with additional discretionary employer contributions. Interesting thing though is that after they set this up in the report, and this is going to be valuable at some point in the future, many of you got your budgets sort of turned upside down and aren't focusing on this issue. Just because they're putting us in there, it's good information, but it doesn't mean that they are expecting you to make additional contributions. This is still discretionary, it's still voluntary. It is just helpful information to have for when the time comes that you're looking to make additional contributions. Also, if you go to page 22 of the report, you can see the breakdown now of the normal costs by your benefit tiers. This is a page that's in place for either agent plans. Agent plans have all the different benefit tiers in one report. This appendix used to be right at the end of the report, or this page used to be right at the end of the report in Appendix D, but because of all the questions CalPERS was getting throughout the year, they thought it important to move it up so that more people are going to be paying attention to it, because most people don't read all the way to the end of the actuarial valuation reports. Also, the other part of Appendix D is the PEPRA member contribution rates. They also move that up to page 23 of the reports. So this, again, consistent with what's changing in the member rates from the prior year to the year that you're going to be making contributions for the valuation. So this is being a June 30, 2019 valuation. The rates take effect July 1, 2021. Member rates get changed to 6.25. For those of you, we're trying to remember how the PEPRA member rates in concept are half of the total normal cost. And we see here from the current rate, the total normal cost used to be 12.5, 6.25 is half of it, and that's the way it is. The total normal cost shifted up slightly to 13.23, but they do not change member rates unless they change by a certain amount. I think it's 0.75%. So if this moves up a little bit more to 13.5, actually I think it needs to, I don't know if it's got to move to 13.5 is I think the point at which maybe it's 0.5% that these changes start kicking in. So it may be in the next valuation report, and again, it partly depends, this being an agent plan, it depends on the demographics of that agency. The older the age at hire of your new PEPRA employees, the higher the normal cost rate goes under normal circumstances, and also if assumption changes kick in, the higher the normal cost rate will also change as assumptions change. If they get more conservative, it will go up. If they become a little more, if they're going in the other direction, they'll go down.
Ira, we had a couple questions regarding the employee contribution rate, and they were referring back to a previous screen, but since we're talking about that, I thought we could answer that. One was, why does the employee contribution rate say 7.5%? I thought it was a flat 8%.
And here, why does it say 7.577 versus 7.55? Again, this is an agent plan, so this is a combination of the rates that they are paying for the classic members, which may be a fixed rate like 8%, and the PEPRA members that are paying 6.75. The other thing that also affects this slightly is for those of you who are in Social Security and modified plan provisions, you make contributions on pay in excess of, I don't remember what it is, like $133 a month, which was the Social Security wage base back in the 1960s. So that the employee contribution rate, which may be 8% for amounts after that on your total payroll, are actually average out to a little bit less than 8% of the payroll overall. So there are some actuarial sort of fine tuning that goes into the rate that they get. This effectively becomes the contribution they're expecting to get to relate and divided by the payroll they're expecting to get for the year. So there are some small issues that fine tune, which is why for many agencies you don't see a flat 8% number showing up for those.
Great, thanks, Ira. That answered, but there were two questions around the same idea, and Nancy has indicated we answered her question here. So I think you can go back to where you were.
Ooh, all right, we got one right. Okay. I mean, I expected that. Yeah, we do that. Yeah. Okay. Now, looked at these rates. Okay. Now we're looking at contribution projections. Contribution projections are show up in two places. They show up on page 6 of a simple version of this, which is just related to the assumed rate of return of the investment return hitting 7%, the assumed rate of return. Shows up early in the report on page 6, and then a more detailed version like this shows up in the reports on page 25. Those things have been in the reports for a few years now. The one thing that's different now, if you looked at these in past reports, you would have seen that the normal cost percentage was calculated for the current valuation and stayed the same amount each year. They ran it with the current population and assumed the population was the same group of people each year moving forward. What they have changed, which makes it more consistent with the way that the GovInvest software operates, is that they are now doing projections out into the next years in the future for the purpose of this report, assuming that people are going to leave based on the current assumptions and that the new people coming in will be PEPRA people, and the PEPRA people have a lower total normal cost overall, a lower employer normal cost overall, so that you can now start to see how the normal cost percentage is going to be expecting to drop year by year, a little each year, because of new hires, people leaving who are classic members, and new people coming in who are PEPRA. For those of you who were looking at your results on the GovInvest software, you saw this happening, and now CalPERS is adjusting their reports, fine-tuning their process to be able to show that happening moving forward. Okay, the next sort of thing that is a change in the report, which also I think is a change for the better. In the back of the report, CalPERS has a number of metrics showing of sensitivity to changes. So knowing that the results that actually occur are never going to be exactly the same as the actuarial assumptions, part of what CalPERS does is they let you know what would happen if they change some of the assumptions or experience is slightly different than expected. So this is sensitivity to assumption changes. The sensitivity to interest rate assumption changes, they've moved in with the discount rate changes. And so they still have the two tables. One is just a discount rate change that shows what happens if the discount rate goes up 1% from 7 to 8 or down 1% from 7 to 6. They're also showing what happens if the inflation assumption goes from the current 2.5% level up 1% to 3.5 or down 1% to 1.5. They, in this case, are now assuming, rather than just having the inflation assumption change, but the discount rate staying the same, they are acknowledging that realistically they are focusing on the real rate of return. The investment structure that they have, the asset allocation that we showed before, largely determines the expectation of real rate of return. So if the asset allocation stays the same, but the inflation expectation goes down, then the discount rate will be likely to fall. So if they expect the inflation assumption to drop from 2.5 to 1.5%, what they are most likely to do is keep the real rate of return where it is and have the discount rate drop. So now these sensitivity measures reflect that the discount rate will drop, that the inflation assumption will drop. What probably also happens is the salary assumption, the salary growth across the board, which is connected to inflation, will also drop. And so you start seeing less movement in the funded results coming from this inflation drop. And again, it's a more realistic picture of what they would expect to happen with lower inflation. This is also one that we should keep a close eye on this year, because the Fed has dropped rates down dramatically. And at least in the short term, they're doing that because the economy is not doing well and there is almost no risk in the short term of inflation. This the bond returns have dropped down. This is, one of the scenarios that they will be maybe reviewing over the next year, whether inflation assumptions are going to be dropping or rising. We'll talk a little more about that when we get to the end of what to expect moving forward. Also, they put these measures, these volatility measures and maturity measures into the report for the first time, I think last year, but they had them for a couple of years. Now they also added a section with some history. So you're not just looking at last year and this year. You get a chance to look at, for the maturity measures, what's happened historically. I think they're going to try and grow this to a 10-year history so that you can see how your population is shifting. These different measures, this first of all is the ratio of retiree accrued liability to total accrued liability. If more of your liability is retiree liability, that means that when the liability shifts because of assumption changes, assumptions becoming more conservative, that these changes will, as a percentage of your payroll, be a bigger move. So if you have a lot of retirees, that means that these changes may end out having a big impact as a percentage of your payroll, because you're making payments as a percentage of your payroll. So this is something to work about as these things are rising. Likewise, the support ratio talks about the relationship between active population and retirees. These two are similar type pieces of information. The fewer active members you have to support the number of retirees, the bigger the impact is the percentage of pay. Asset volatility ratios show you how much the costs will move if the investments are not earning what they expect to earn. So as the plan gets better funded, these asset volatility ratios go up. So in general, you want your plan to be better funded. That's a good thing. But sort of the short version is, the more money you have in the plan, the bigger a loss you take if the markets don't achieve what we're expecting them to get. On the other hand, the bigger the gain you get when the markets do better. And finally, the liability volatility ratio is how much the liabilities are going to move as the interest rates change. And again, the more these things rise, the bigger the impact of assumption rate changes moving forward into the future. The other thing to notice, again, there's a hypothetical termination liability. Because the interest rates have dropped so dramatically, these liability ratios, last year they were showing them, I think, at 2.5%. Now they're showing them at 1.75%. The lower the discount rate, that is, and this is a measure of sort of a risk-free, medium-term, safe, investments, government treasuries. And if you were to try and get out of CalPERS and not be making future contributions to them, they would be locking your liabilities in with safe investments so that they're not expecting any gains or losses. Those safe investments now are getting a lesser return than they were before. So that's why these rates are dropping. This is not a guarantee of the rate you would get if you were to leave CalPERS and try and lock all this in. This is just their best guess as of the time they were putting the reports together of what those rates would be.
Ira, we have another question.
Okay.
We have two questions.
Ooh.
So I'll read them to you. Regarding the difference between the discount rate versus the real rate of return, what is the simplest way to explain the difference to our elected officials?
In terms of our software, when we use the term discount rate, we are talking about the assumption that CalPERS is using for their long-term assumption for their investment returns for all years after the valuation date in that particular valuation. So they have a single rate of return. That is the average rate that they are expecting to get for all years in the future. In our software, the investment rate of return reflects the return of the assets in that particular year. Now, for those years that are in the past, we know what those returns are, and our software, we plug in for you as soon as CalPERS announces it. Like when CalPERS announced the 4.7, we plug that in. That is just a return for a single year. And if you want to see what happens if CalPERS keeps assuming, for example, a 7% return, but achieving a 6% return in future years, 1 year at a time, you would keep the discount rate at 7. That's under the control of the CalPERS board. You would move the investment return assumption to reflect 6% in those future years. And then see the losses, which is what happens when you achieve, when the actual investment return is less than the assumed rate of return, and see how your costs would be rising slightly over time because of that. So when we use the term investment rate of return, it's a 1-year return that's either actually happened or you expect to happen in that year. The discount rate is the rate that the CalPERS board sets for doing their valuation based on their expectation and their model and actuarial standards of practice. Nina, did I miss anything?
No, I think that's good, Ira. Perfect. So now we have another question, 2 questions. Okay. Can you please repeat the meaning of the support ratio in the previous slide? So
No, I can't. I've already forgotten. No, the support ratio is, I think if I remember correctly, a ratio of the number of active employees to the number of total plan members. I don't remember if it's total plan members or total retirees in the report. But as the number of retirees grows, so for many agencies, over time, the number of retirees grows. People retire, retirees just keep living, and your active population stays relatively stable. As people leave, you replace them, but you keep the same number of active employees, the number of retirees starts to grow. So your support ratio, you have fewer active employees to support the number of retirees that are going on over time. And as this support ratio starts to decline, like we are seeing for this agency, and this is a relatively stable agency, then that's an indication that if liabilities shift because of assumption changes that may be happening at some point in the future, you're going to have assumption changes for both active members and retirees, and if you have, and then your costs get spread over your active employees. So if you are looking at how your cost is going to change as a percentage of payroll, you will have a bigger change as an assumption of payroll because you have fewer active members to spread it over. So that's what the support ratio is.
great, thank you. And we have one more question. I know we have one additional slide after this, but this is in regards to the termination liability. Is the termination liability negotiable? Is the city allowed to pay it off over a period of years?
I'm not sure about this, but I think, first of all, in general terms, it's not negotiable. You don't go in and say, here they want $1 billion. I've got 800,000. I can give it to you in cash. This is
that's
not
my understanding.
Right. That's the kind of thing you think about would be happening in Chicago or New Jersey. But this is a rate that they set. The rules are set by law, and this is what they need to do if the ability for your agency to pay moving forward gains and losses goes away. I'm not sure, I do not believe there is an opportunity to pay this off over time through CalPERS, but that I'm not sure of.
Yeah.
I do not know of any agencies who have asked that question. Nina, do you know
Right.
of any?
No, I don't. I'm with you. That's what I think is correct, that they're not allowed to pay it off over a period of time. But
Yeah, and this is, and when this has happened, this is because an agency wants to walk away. This is usually not an agency that is, you know, interested in setting up a deal with CalPERS. That's why they're getting out.
right. All right, that wraps up our questions for the moment. So I think you can get to your, I think we have one more slide.
Let's start talking about what to expect next year, because again, 1819 was a stable year. 1920, to quote Hamilton, the world turns upside down. We got, and again, we got a 4.7% return, which is not a reflection of the volatility that we saw during the 1920 year, with markets plummeting at one point, down 30%, and coming back. And for those of you who've been following the markets recently, watching the S&P move all the way back and hit a new high. This is not, as you are aware, the economies haven't suddenly been fixed. You are seeing your revenue still being crushed. So this is largely due to the Fed basically priming the pump and moving things up so that you know, the stock market is doing well. At least the financial markets are stable. But the economy is not. There is still a huge amount of volatility in the markets. And when there's volatility, that eventually tends to go both ways. So it is harder than normal to predict where the markets will be. Markets have normal amounts of volatility, and we see those if we go back actually to this graph and you see the different returns. There's a normal amount of volatility that shows up in here. We're talking about much bigger volatility than normal, and we're expecting to see bigger swings in all of this. CalPERS is going to be looking at their asset allocations, their assumptions, and other things moving forward, adding to the uncertainty. CalPERS Chief Investment Officer recently left. So they had been sort of following his lead, and from all indications, he was coming up with an approach to try and keep returns likely to be close to 7 moving forward. When they bring in a new Chief Investment Officer, they're having the deputy take over right now, but they're looking for a new one. When they bring in the new one, we do not know, we cannot know whether that new Chief Investment Officer is going to have the same philosophy moving forward, the same approaches. And so we're going to have to keep a closer eye than we would have on what's going to be happening with the asset allocation, the discussions they're going to be having starting in January, and the assumption changes that they'll be having throughout in early 2021. Also, for many of you, and you know this is happening, you have either started having workforce changes, having furloughs, cut back on pay, other things to deal with revenue drops. For those of you who weren't as impacted as much by sales tax drops or TOT reductions, or had nice reserves, you're still looking forward and saying we don't know where things are moving forward. So more agencies more and more, some of them had changes that they put in for your workforce before June 30, 2020. In the 2020-2021 year, you're also going to be discussing them. Again, because of the volatility, because we don't know when the revenues are going to turn around, the economy is going to turn around. It's hard to predict, and many of you are having much more regular discussions with your city council, with your finance groups, to figure out how you're going to get through this moving forward. So we're going to keep an eye on this moving forward, and there are going to be changes. Also, on the assumption side, CalPERS has announced that they're not going to have any assumption changes moving forward for the June 30, 2020 valuation, but as part of their regular process, they're having meetings beginning in the next year to determine assumptions moving forward. And again, they're going to be looking at the demographic assumptions, the retirements, the turnover. It's going to be harder for them to use information from the current year moving forward because we're hoping that any of the layoffs and terminations and other things that we see this year are short-term type things, and they're not going to be recurring year after year after year. But on the economic side, because of the changes on the drop in the discount rate by the Fed, followed by the priming by basically sticking a huge amount of cash in, they're going to be carefully looking at their economic models, their expectation of future Fed activity to decide whether, how much weight they give the current interest rates versus the probability of inflation kicking back in when the economy starts turning back on again. This is, it's always, interesting, but this is a lot more complicated than it has been. And so the board will be having discussions in 2021, and we'll be monitoring them. Many of you will also, but if they have something interesting coming up, we'll probably be bringing it to you in a webinar. Yeah, go ahead.
Ira, we have 3 minutes left. We have a number of questions, and we won't be able to answer them on the webinar, but we will contact, some of you put anonymous, so it'd be hard to contact you, but we can do that. If we can follow up, right, Max? We can follow up to everyone who registered and answer these questions we have.
Yeah, folks that posted questions with their name will be able to reach out to them. You do see a lot of familiar names here.
Great. So I think that's great information that CalPERS has announced no assumption changes for the next valuation. That's good information for people to hear. What do we want to answer one question, or are we wrapping up? Max?
Let's see here. I think we have probably time for one question, if there's one you see that you could.
Let's do the anonymous one. So Ira, wouldn't the support ratio from classic members decline as the replacements are generally happening with PEPRA plan employees? Is this correct? If so, what would this mean to our organizations?
It means while the first of all, overall, we would expect still for most agencies for your support ratio to be sort of declining overall. But what for those of you who are in the risk pool, you're going to see your classic contribution rates increasing as a percentage of payroll overall, because the unfunded liability payments will continue to grow as your payroll continues to shrink. So as a percentage of payroll, it'll look bigger. As a percentage of your overall payroll, it should be a lot more stable. And again, if interest rates start dropping, and part of this is what you have probably seen in the last few years as they were dropping discount rates, as you start, those agencies that had larger retiree groups in relationship to their active group saw bigger changes overall in cost as a percentage of payroll and total dollar amounts than the others. So again, you're thinking properly to try and pull it all back together, to look at the pieces separately, and then come back and see how the total impact. Hopefully.
Okay, great.
Again,
thank you, Ira.
Yeah, and thank you all for being here, for participating, for asking questions. And we'll do our best to get back to you with answers to all this. And if not, feel free to give us a call, to contact Max, and he will arrange either answer the questions for you or arrange some time to speak with somebody who will help you walk through this. Our next webinar is going to be, as usual, the third Wednesday of the month, September 16th. We will be sending out information about the topics once we get them finalized. We've got some interesting thoughts right now, but we don't want to sort of announce them until we've decided, because who knows what is going to happen next in this world. Nina, any last things you want to say?
I just want to thank everyone for their attendance. It was nice chatting with all of you. And yes, we'll get those questions answered. And you can reach out to the info@govinvest.com and we'll get those questions answered.
Okay, thanks all. Thank you all for
Thanks,
coming.
everyone.
Have a great day.
Bye.